In America, a three-digit number can quietly follow you into some of the biggest financial decisions of your life. An apartment application, a car loan, a credit card, a mortgage, sometimes even the price you pay for insurance. For many U.S. women, the FICO score can feel mysterious or even intimidating. It can seem like a judgment on your character or your personal success. But the algorithm doesn't know your salary, and it doesn't measure your worth. To understand exactly how the system works, we have to look at the mechanics. Please note that the information we are covering is for educational purposes and is not personal financial, credit, legal, tax, or investment advice. At its core, the FICO score is a mathematical risk model. It uses specific data points to predict the likelihood that a borrowed dollar will be paid back on time. When you learn how to read those data points, the score stops being a source of anxiety and becomes a predictable map. Seeing exactly how your financial data is tracked, scored, and requested is the first step to taking full control of the financial options available to you. The process starts with a historical transcript called a credit report. In the U.S., 3 major bureaus, Experian, Equifax, and TransUnion, collect information from lenders. They record your past accounts, the balances you carry, and your payment history over time. This diagram illustrates the relationship between that report and your FICO score. The report is just a raw list of data. The FICO algorithm is the mathematical filter that reads that list and generates a 3-digit grade between 300 and 850 to predict risk. If we zoom in on the report itself, we can see exactly what the algorithm is reading. It looks at your total credit limits, your current balances, and a log of who has recently asked to view your file. Because the score relies entirely on the report, there is no shortcut to a higher number. Changing the output requires managing the real-world financial actions recorded on the input. This chart breaks down the exact ingredients of the FICO formula. The largest piece, making up 35% of the total calculation, is payment history. This factor evaluates one simple behavior: whether bills are paid consistently and on time. The second heaviest factor controls another 30% of the score. This category is called amounts owed, though it is most commonly referred to as credit utilization. Credit utilization is the percentage of your total available credit limit that is currently tied up in a balance. If you have a credit card with a $1,000 limit and a balance of $500, your utilization rate is 50%. While general financial advice suggests keeping this ratio under 30%, this chart reveals how top FICO scores actually manage their limits. Those with the highest scores tend to maintain single-digit utilization, typically hovering between 1 and 7%. The remaining 35% of the score is split between 3 areas: the length of your credit history, your credit mix, and new credit. These factors reward consumers who demonstrate long-term stability and experience managing different types of debt, like a mix of revolving cards and installment loans.
Payment history and utilization dictate a massive 65% of the overall calculation. Directing your daily financial habits toward paying on time and keeping revolving balances extremely low produces the highest return on your effort. When you submit an application for an apartment lease or an auto loan, the landlord or lender will pull your credit file to review your history. In the credit system, this event is recorded as a hard pull inquiry. A hard pull can temporarily drop a FICO score by a few points. It signals to the algorithm that a consumer is actively seeking new, unproven debt, which slightly increases the statistical risk. There is a second type of check called a soft pull. Soft pulls happen when you check your own credit score, or when companies review your file to send pre-approved offers. Soft pulls are invisible to lenders and never impact your score. The FICO model builds in protection for consumers who are shopping around for the best rates. If you apply for the same type of loan, like an auto loan or a mortgage, multiple times within a 14 to 45-day window, the algorithm groups those hard pulls together and counts them as a single inquiry. You do not need to avoid your own credit report. Monitoring your personal data is always a soft pull, and keeping a close eye on your accounts is a required habit for maintaining long-term financial health. Credit bureaus are massive data aggregators, processing millions of files daily. Data entry mistakes happen. An account you closed might still show as open, or a case of identity theft could attach fraudulent debt to your name, dragging down your score through no fault of your own.
The Fair Credit Reporting Act ensures that you can check for these inaccuracies. You have the right to request weekly free credit reports from annualcreditreport.com to verify every line item attached to your identity. Historically, in the United States, consumers had very little visibility into how their credit was tracked, traded, or scored behind closed doors. Today, the legal framework provides direct oversight. If you find an error on your report, you have the right to file a formal written dispute with the credit bureau, providing supporting documents to prove the inaccuracy. By federal rule, the bureau generally has 30 days to investigate the claim, verify the data with the business that reported it, and either correct or remove the inaccurate information for free. Reviewing a credit report is an active audit. You are examining the data that shapes your financial life, and you have federal law backing your demand for absolute accuracy. The FICO score operates on a strict set of rules. It is a mechanical system of inputs and outputs designed to measure statistical risk, nothing more. On time, optimizing utilization, safely managing inquiries, and actively disputing errors places the leverage entirely in your hands. Financial clarity removes the friction of the unknown. It transforms the credit score from a source of hesitation into a clear, predictable signal of your own financial mobility.